How would you feel if you never had to pay federal income tax for the rest of your life? I'm assuming you'd feel pretty good, and I'm assuming if I told you how to do that today and showed you if that's a reality or not, you'd probably find this video pretty helpful. And so that's our goal today, is to show you how to get to what we call the 0% tax bracket, and what I personally call legally divorcing the IRS for life. And so that's the concept that we're going to discuss today. And we're going to start by looking at the federal income tax rates on your screen here. Many people, when they look at this bracket here, they think, hey, I'm in the 22% bracket. My taxable income is $100,000. I have to pay 22% on everything. That's actually not how it works. It's actually a marginal tax bracket, meaning that you'll pay 12% on the amount from $23,000 to $94,000 if you're married, and then from 10% from $0 to $23,000. But I want to even take this a step further and express that there's actually even a bracket before this 10%, and it's what I call the 0% bracket, and it's there over here on our right. And so on our right here is a standard deduction. And so what this means is that if your taxable income, if you're married filing jointly, is $29,200 or less, you pay no taxes. So if you made $29,000 and that's it, you don't have to pay federal income tax rates for that year. And so that's the standard deduction. And so that first $29,000, 0%, and then that next $23,200 if you're married filing jointly would be at 10%. And so that's how our brackets work ongoing. So back to this standard deduction. Remember I asked how would you feel if we can keep our income in that 0% bracket and not have to pay any taxes? You'd probably feel pretty good. But here's the question I have. Do you want to eat ramen noodles and live in a cardboard box to do so? And of course the answer is no. So how do we lower our income in retirement while still having the money we need to live that retirement that we want to? And so there's many ways we can do this, but one particular strategy that we share often is what's called a Roth conversion. Moving money from your tax-deferred vehicles, your IRAs, your 401ks, moving that into a Roth type vehicle, a Roth IRA, Roth 401k. And in these vehicles, when you take out money, it does not count as income. So if you take out $100,000 from your IRA, well, that all counts as income. If you take $100,000 out from your Roth IRA, that's all tax-free. That doesn't count towards this chart here, but you still get the money that you need to live on. So the goal here in the future is to show the IRS we have a lower income. The goal is for us to not have a lower income. I want you to enjoy your retirement. I do not want you eating those ramen noodles. And so for our goal here today, in order to get to that 0% bracket, we need to keep our income lower in the future, which means we may want to increase our income now while tax rates are what I call on sale, and while tax rates are expected to go up here in the future in 2026 and ongoing. Let's make sure we can take advantage of the opportunity now and position ourselves in the future to not have to worry about these federal income tax brackets. So I want to make it very clear also that this type of strategy and planning is not for everyone. So for example, let's say you have a pension, or let's say your pension's over $29,200 a year. Well, the 0% bracket is not going to be reasonable for you, obviously, but that doesn't mean that these principles in what we're talking about today does not apply to you. It still is going to apply to you because your goal should be, again, to keep your income lower. 0% may not be reasonable, but the lower you can keep your income, the less you'll pay in Medicare premiums, the less you'll pay in Social Security tax, the less your tax brackets will be. You can keep your capital gains in 0%. All of this stuff plays together. So regardless of your situation, these concepts are going to make sense. Don't let the 0% bracket get in the way. But for some of you, that 0% bracket is very reasonable. And we do that with a lot of our clients, even those with $1 million plus that we typically work with, because of great planning and being proactive versus reactive. We can get ahead of this now and set ourselves up for success moving forward. You're going to have a lot more money in your pocket and less to Uncle Sam is ultimately our goal. So we need to understand this concept of the standard deduction. Make sure you write that one down. I'm going to come back to it within this video. The next thing we need to understand is capital gains that I just mentioned. So in order to legally divorce the IRS from capital gains, well, as long as our income is under $94,000, which again, this is taxable income, so it's $94,000 plus that standard deduction we talked about, which is $29,200, if you add those two numbers together, you can sell off capital gains up to that point and pay no tax. So I always share a story about one of the clients we had who had $100,000 in Apple stock. He bought it for $20,000. So if he just sells it while he's working and in a higher income, let's say he's in the 15% bracket, he has to pay 15% on all of that growth. Now, if he retires and doesn't have any income at all, doesn't start Social Security, doesn't start his pension, he'll find himself in this 0% bracket, which means he could sell off all that Amazon stock and he's not paying any tax on any of that gain. And so something we want our clients to realize is be aware of these capital gains brackets. And this goes pretty high, almost 120,000, over 120,000 in retirement that we can utilize. And so if you're not expecting your income to be 120 or more, make sure you understand that we can sell off some capital gains in the future at 0% brackets. And so this is a planning item that we want to start having in our mind so that we can take money from our investments and not have to pay any taxes. That's a great place to be in, and this is one way we can do it. The next thing we need to worry about is Social Security tax, right? So we can't be in that 0% bracket if we force our income up too high past the standard deduction, but also now we start to force Social Security to be taxable. So let's show you how you can get your Social Security tax-free. I always ask when I do these workshops or webinars or whatever it may be, I go, is everyone okay if I show you how to get your Social Security tax-free? You know, bring it back to the before the 80s when it used to be tax-free until they, and now they changed the rules. So that's what we're going to talk about here. So with Social Security tax, you start with your provisional income. You take all these items here and you add those up, so half your Social Security. So if you have $40,000, that's $20,000. Ordinary income, that's pensions, investment withdrawals. You know, RMDs could be part of that. If you're still working, that would be included there. You know, right now we're seeing a lot of taxable interest is included there from your bank accounts, your CDs, things like that. Capital gains and dividends, that's going to be your non-retirement type investments. That's going to be your real estate, your rental properties, anything you sell there, and is going to be counted towards that. And then non-taxable interest, which is muni bonds. But again, most people have their money in these first three categories here. So you take whatever that number is and you bring it to this chart here. And based on that number is what the amount of your Social Security benefit is going to be subject to tax. So if you're able to keep that provisional income under $32,000 if you're married, or $25,000 if you're single, you don't have to pay any tax on that Social Security benefit. That's a great place to be. But as soon as your income starts increasing, more and more your Social Security is now subject to tax, and it can get up to 85% taxable, which is very reasonable for many people that we work with, is to find themselves in what we call the Social Security tax torpedo, and that's where you force your Social Security to become fully taxable, as I'm showing you there on the screen. So again, what's the name of the game? Keep your income lower in retirement. If we can keep our income lower in retirement, we can allow our Social Security benefits to not go to Uncle Sam as much. We get to keep more in our pocket. And that's ultimately our goal, because you've worked hard for your money. So how do we preserve it and keep more of it in our pocket? So that's the idea there with the provisional income. So the next thing I want to talk about here is how all this plays together with Social Security and how you can find yourself in that 0% bracket. So we're going to play in two things here. We're going to show you two examples. We're going to show you Bill, who takes his money out from his IRA and he takes Social Security out at 62. And then we're going to show you on the other side of a character named Jill, who she's going to take her Social Security at 70, and she's going to take some money from different types of investments. So again, this is not a recommendation. This is not anything other than the fact to show you an illustration, to show you the impact of when you take out withdrawals from your investments in retirement, when you decide to take Social Security, all of that stuff plays together. I'm not here to tell you to take Social Security at 62 or 70. That's going to depend on your situation. Some of our clients take it at 62, some take it at 70. It's going to depend on what your goals are and what your asset size is and what you're trying to achieve. And also your health is a big one, right? And so for Bill, he took his IRA, which means that he's going to have to take out a majority from that since he took Social Security at 62, because that's a lower amount. And so his total tax bill is going to be about $8,800, and he's no longer working. So he's no longer working. He has to pay $8,800. That's a lot of money when you have no longer any income coming in, but because he got his tax benefits early, he has to now pay them. And so that's the case with Bill. Now, Jill, on the other hand, is going to have a little bit of mixture here. So we just did two things differently with Jill. One is we took Social Security at 70, so now more of her income is going to come from Social Security, as you can see. And we also decided to put more money to a Roth throughout her working years, throughout her early years of retirement before she started Social Security, in order to have what we call more of a balance. Have the ability to pull from an IRA or have the ability to pull from a Roth now gives us what we call tax diversification. Not all of our eggs in one basket, right? Not everyone here has all their money in Bitcoin, but when you look at most people out there, they have all their money in tax deferred and none in Roth. Well, we may want to look to have more of a balance so we can choose, because we don't know what tax rates are going to be in the future. It's written in pencil. Tax code's written in pencil. We need to understand and have the flexibility to be able to choose which one we want to pull out from. And that's what Jill was able to do. And because we had that amount of flexibility, and because we planned the right way, we were actually able to position Jill in a situation where she was able to pay $0 in taxes. And so as you can see here, in the federal taxes are going to be $0. And the reason why is because we were able to keep her Social Security under that provisional income limit, which means that the amount of her Social Security that was subject to tax and her IRA were less than that standard deduction of $29,200. So we strategically planned this out to ensure that that was the case. Now you're probably thinking, well, Joe, Jill doesn't want to eat ramen noodles like you talked about. Of course not. And so we took the rest of the money that she needs from the Roth, so she still got the money that, Bill got in the first scenario. They got the same amount of money. It's just the fact that Jill got to keep all of her money versus Bill had to give some of his money to taxes. So that's the difference here. How we can maximize what we have so we can have more in our pockets and not have to give out as much, because you've already paid enough taxes over your lifetime, I can guess. And if I ever ask someone, do you feel like you overpay every year in taxes? Most people say yes, and I don't know what to do about it. Well, the good news is by proper planning and by implementing these strategies the correct way, these are the type of outcomes that you can have by making educated and informed decisions to get there. And so that's what we're hoping these videos can help you with, is to help you understand, here's the type of planning that you can have and the type of savings it can lead to. And so we really want you to understand the impacts of how you take out money in retirement in order to make the best decision here for yourself. And so when we think about the retiree's tax bracket, we think of all those things we just talked about, right? Although most people only look at the bracket that's on the screen right now, which is federal income tax rates. Now, this is definitely a bracket you need to factor in retirement, but this only tells us a few things. It only tells us the tax rate we'll pay and the standard deduction amount. This has no indication of the capital gains bracket we showed you. This has no indication of the Social Security taxation, of how that all plays together. It doesn't have anything to show you about Medicare premiums, about net investment income, and how your income can impact those areas. And so we need to see, how does all this play together? And so something we do for our clients is what we call the real retiree's tax bracket. Now with the real retiree's tax bracket, this is going to show all those things I just mentioned and more playing together to decide what we need to do from a tax planning standpoint. And if you remember the title of this video, it's living a tax-free retirement. It's being in the 0% tax bracket. It's legally divorcing the IRS for life. So in order to do that, if we can keep our income in this area here at the beginning of the chart, that's what we call that 0% bracket. And if you can keep yourself there every year ongoing, you can still take out money from your IRA up to that standard deduction and live that tax-free retirement. So that's something we really want to educate people on, so they understand the opportunity they have there. Now, as I shared, it's not reasonable for everyone to get to that 0% bracket, and so you may find yourself further here on the right of this chart, which is totally fine, but our goal is to keep it as far left as we can to pay the least amount of taxes. Now, let me explain how this chart works. So the blue is what we call our taxes on ordinary income. That's the tax brackets I just showed you, 10%, 12%, 22%, 24%, so on and so on. The purple is going to be the taxation on your Social Security. So remember, as we increase our income, the more tax we have to pay on Social Security. That shows the purple. The red is that capital gains. Once we reach that $90,000, $94,000, now our capital gains turn from 0% into 15%. And if we're just $1 of that line, those capital gains are now at 15%, so we need a plan for that. The dotted lines here are Medicare premium tiers, so that shows as we reach that income standpoint, now we got to pay more for Medicare premiums because it's means-based, it's based on your income, and so we need to understand how all of this plays together, and we really need to watch out for this Social Security tax torpedo here, where you could pay a 40 to 50% tax rate by increasing your income beyond this point, because now you're forcing capital gains taxable, now you're forcing your Social Security to be fully taxable. 85% of it has now become taxable, and you could bump up tax brackets as well. So anyways, my main point here is we need to find our ways to lower income in retirement. The way we do that is by proper planning and making sure we got the right things in place. And so if this is a type of planning that you're looking for, maybe your advisor's not doing this currently, maybe you're doing it on your own and you just feel like you may be missing things, feel free to schedule a time with us. We'll be glad to walk through these types of strategies with you, see if we can add value for your situation. We get a lot of people that reach out to us from these YouTube channels. We love connecting, and we love seeing if we're a good fit to serve you ongoing. If that's you, go ahead and there's a link in the description below to apply for a session with us, and we'd love to see how we can help. So also, if you really like these videos, go ahead, subscribe, share them with others, and we're going to keep them coming, and we're going to try to educate as many retirees as we can to live the retirement that they dreamed of. Hope you enjoyed the video today. As an avid viewer of this YouTube channel, we would like to offer you a free copy of our new book that just came out called I Hate Taxes. So if you would like a free copy of this, then go ahead in the description below. You'll be able to click on a link to get that free copy of this new book, I Hate Taxes.